I think governance is going to become much more important as we go into the next decade. Obviously, we're going to the senior managers regime next month. But I think particularly for boutiques, larger companies have governance. But for boutiques at Troy, we've always had a board, we've always had non-executive directors, which I think has been very helpful for us in managing our business. So I think that other boutiques are probably like to follow on that basis. And I think the regulator is going to want it, but I think most importantly, investors are actually going to want it. They're going to want to be able to see that reassurance that a board gives to the business. We've seen many of the problems of liquidity. I mean, there's nothing worse than being in a lobster pot of an investment. And by a lobster pot, I mean an investment which you've acquired, and which you just can't get out of. And I gave an example in my presentation of EMI, which was a shocking investment for us. But the fact that it was in the FTSE 100 meant that we could have liquidity to get out. If you're in smaller and mid-cap stocks, it's much harder, particularly if you've got large stakes in companies, to actually exit if you need to exit. And so that actually gives you greater flexibility as well. So I think liquidity is important. The Trojan Fund, which I run, has got something like 95% liquidity. We could liquidate the portfolio within a week in normal market conditions. So I think that hopefully gives some reassurance to our investors that should they wish to sell their shares in the fund, that we can actually realise their investment for them and give them their cash back. I think it's just going to become more important over the next few years. The value versus growth argument is incredibly nuanced. I mean, we gave an example in an investment report recently which had Alphabet being in the growth index and Procter & Gamble being in the value index. They're stocks that we both hold. And actually the valuation of Procter & Gamble was higher than the valuation of Alphabet. So sometimes there's actually no logic in how these things are measured. But I think we are living in a world that is disinflationary and deflationary for the time being. And so many companies are going to really struggle to get pricing power. And there's also sort of technological innovation, which is actually destroying businesses in the way that a number of sort of retailers are struggling with the threat of Amazon. So I think that we need to be very careful about not necessarily chasing growth, but be very careful about avoiding value traps. Well, the levels of debt globally keep going up. One of the things after the crisis 10 years ago, there was a lot of talk about deleveraging. That never really happened. It happened to some extent in the banks, but it certainly didn't happen from the point of view of governance. So the global debt pool has continued to grow and grow quite quickly over the last decade. The only way out, what the debt does is it means that growth is relatively modest, because every incremental amount of debt that we take on means that is less and less effective. The only way out of that debt in the very longer term for countries that can print their currency, and clearly that's not the case necessarily in Europe, but in the UK and the US it's certainly the case. The only way out is through more printing and probably inflation further down the line. We're not there yet. Still, the deflationary forces of technological change and demographics are very much with us today. But actually in the longer term further out, the only way out of that debt will be to inflate our way out, and we need to, as investors, be aware of that. Gold is essentially a diversifier. It's essential insurance, we see it, within the portfolio. If equity markets were to fall sharply due to either some sort of financial dislocation or rising inflation, then gold should give us good returns in a period where perhaps equities wouldn't. So it's an offset for us. We've held gold going back since 2005 in the portfolio. It's compounded at about 12% per annum in sterling over that period. So it's been a very good investment for us. Clearly it hasn't always gone up when the equity market's gone up. So from that point of view, it's been a helpful diversifier as well. So we think that as we live in a world of negative real interest rates, and I'm afraid that's something which is going to persist, we think, for quite some time to come, we're not going to be in an era of what's called sound money, of positive interest rates, and that's why gold will continue to have a role in the portfolio. When we are moving to a world where we have positive real interest rates, then clearly we won't need to hold it any longer, but I think we're a way away from that.